Welcome to Objective 6 in Unit 4 of Accounting 3310. This objective discusses depreciation. This is a topic that you already know something about because it has to be covered in any Principles of Financial Accounting course, and so we have mentioned it on and off throughout this course already, but now is the time for us to learn more specifically about depreciation. Depreciation is the term for the using up of long-term assets whose productive capacity diminishes with use or time. Accountants allow only a few small exceptions to the assertion that all long-term assets decline in value, but it's important to acknowledge that there are some assets that may appreciate. Because of the rapidly escalating price of new airplanes, some 10-year-old airplanes may have a used value of more than their original purchase price. What does GAAP do about asset appreciation? Absolutely nothing. Your company can write a footnote disclosure about it, but in U.S. GAAP, assets are only written down and never up. How does depreciation appear in financial statements? Our objective here is that students will be able to allocate depreciation of assets during their useful lives at the end of this objective. Depreciation is the allocation of cost to period of use for an asset. The entire value of an asset is eventually reflected as a reduction to net income, either during use or during disposal. What is depreciated? All long-term tangible assets are depreciated, except land. We're going to use the term depletion for long-term assets that are natural resources, such as standing timber, coal in a mine, or oil in ground. We're going to use the term amortization for intangible assets. There are some intangible assets that will not be amortized. The exceptions are goodwill and indefinite-lived intangibles. Most intangibles have a useful life the same as cars or equipment do, but some are a contract that can be continuously renewed so that it's on an ongoing basis. It has, in effect, no end point. Trademarks are a good example of that. Depreciation is the systematic and rational measure based on historical cost. It does not attempt to measure the fair value of the assets on an ongoing basis, and it does not attempt to adjust for changing price levels or changes in physical capacity. So companies that have a very long history may have headquarters on land that was purchased 50 years ago, and just the purchasing power of the dollar is such that their original price for that land is vastly understates what its current dollar price would be. We make no adjustments for that. So, as we look at the planned assets on the books of a company, there's a potential to have a systematic bias downward and to understate the value of assets. Before recording depreciation, a company must gather the following information. What is the service life of that asset? What is the residual value at the end of the service life? And what is the allocation base? That is, what's the total amount that needs to be depreciated over that service life? Let's talk about determining the service life. It could be measured in terms of time, or it could be measured in terms of work. If it's estimated in years, it's the estimated years of productive use by the current owner. So, if your company wants to have always very new-looking delivery trucks, such that you buy new delivery trucks every 3 years, then despite the fact that the delivery truck has a physical life that may last 10 or 20 years, for your company, the life of that delivery truck is 3 years, and you'll estimate the residual value as of the end of the useful life to your company. Life in years is also not necessarily the same as the tax life. For tax purposes, depreciation is taken based on very rigid rules so that assets are assigned to a particular life over which one can deduct for tax purposes depreciation. That does not influence our estimate of useful life for financial reporting purposes. The other way to measure service life is by the estimated number of units of output by the current owner. Often when one buys equipment, it's measured for a particular capacity. That is, a copier may have a useful life measured in terms of the number of copies it will make, or a machine tool may be measured in life by the number of cycles that it will go through. It is not based on the maximum capacity, again, but it's based on what you will use it for. So if you typically are going to be replacing equipment as soon as it hits 100,000 units of work, then that's the capacity in units, even though it has a residual value at that point. The residual value is also called the salvage value. It's the expected value at the end of the service life. Required disposal costs must be included in the value of the asset. We have talked about asset retirement obligation as a portion of that residual value at the end of the life of an asset. The allocation base is basically the historical cost that you have paid for the asset. The asset value used to compute depreciation differs with the depreciation method. Some depreciation methods consider the residual value as subtracted out to get the allocation base, and there is at least one depreciation method that only considers residual value after depreciation has been calculated and makes adjustments for it afterwards. We have a lot of information that needs to be gathered on depreciation methods. When are these factors estimated? Theoretically, they're estimated each year so that we always have an accurate number for the service life and the residual value and the allocation base of the asset. Practically, the service life and the residual value are often estimated once at the time that you purchase the asset, and given a lot of experience with assets, that is usually sufficiently accurate for the entire life of the asset. However, we know that there are some expenditures subsequent to acquisition that may impact the allocation base. That is, there may be additions that have to be added into the asset base, and there may be impairment that needs to be subtracted out. So it is something that needs to be reviewed on an annual basis to make sure that the depreciation for the year is based on current underlying facts. We're going to look at 3 depreciation methods. The straight line method is the most commonly used method in accounting. The declining balance method we're going to illustrate because it's an accelerated method that is built into our tax code, so you will meet the declining balance method even if your company uses straight line method. And finally, we'll take a look at the unit method, which is the method that tries to measure service life in terms of the amount of work produced. This has the greatest adherence to what the theoretical value of an asset would be, but it is difficult to use for many kinds of assets. The general form for all of the methods is that annual depreciation is equal to some fraction based on the service life multiplied by some allocation base. For example, with a service life of 5 years or $100,000 units and a residual value of $5,000, the allocation base for this asset would be the acquisition cost of $25,000. We have no enhancements or impairments. And we're going to estimate the units of output for each of the next 5 years. And we'll simplify this by saying our expectations are what actually was realized for this asset. In this case, the straight line method would use as the fraction 1 divided by the service life in years, or 1/5. If we put that in percentage terms, that's 20%. That is 20% of the value of the asset will be depreciated in each of the next 5 years. Well, what do we multiply that fraction by? It's going to be the cost basis minus the residual value. So we'll take that acquisition cost of $25,000 minus the $5,000 residual value. So our completed equation is going to be 1 divided by the service life times the acquisition cost minus the residual value. Substituting in the values from our fact situation, the annual depreciation is 1/5 times 20,000, that cost basis of 25,000 minus residual value of 5,000, which is equal to 4,000. When there are no changes in the depreciation factors in subsequent years, the straight line depreciation result that we calculate for the first year is going to be the same number that we get for each of the subsequent years. The chart on the next slide recalculates straight line depreciation each year using the current information, assuming that there's no changes in the depreciation factors. Let's take a look at it. So in year 2003, the first year we bought the asset, it has a 5-year life. In 2004, we've used it for 1 year, so it has a 4-year life. In 2005, we've used it for 2 years, so it has a 3-year life. So you see how that remaining service life changes in the 4th row down in the table. The carrying value of the asset is the value that it's on our books for. That's going to change each period because as we take depreciation, the carrying value of the asset declines. And so in the first year, we're going to take straight line depreciation of 1/5 of 25,000 minus 5,000, which is 4,000. Now think about the next year. Since we've taken 4,000 in depreciation, the current carrying value of the asset now is only 21,000. We are keeping the residual value of 5,000, and we're keeping the same service life, which in the second year of the life of an asset is now down to 4. So when we take straight line depreciation this year, we have 1 divided by 4, the remaining service life, multiplied by the carrying value of the asset, 21,000, minus the residual value of 5,000, and we get 4,000 for the appropriate straight line depreciation in the next year. So, as we go through each year in a normal straight line example in which there's no changes in any of the values, we can calculate individually each year depreciation and it will be identical. This suggests a shortcut. That is, we can calculate it in the first year and have confidence that we can use that number as the straight line depreciation in every other year. Now, if something changes, then we've got to start from scratch. So if there's some point at which we decide the residual value is really going to be only 1,000, or if there's some point at which we decide, this is a terrific asset, it's going to last way more than 5 years, it's going to last 8 years, then we will have to recalculate straight line depreciation. When a depreciation factor changes, you can be comfortable taking the current carrying value of the asset, which is the acquisition cost less all of the accumulated depreciation taken so far, and whatever those current estimates are, and calculate a new depreciation amount. Remember to always use the current carrying value in the allocation base when depreciation factors change. This is the end of our discussion of straight-line depreciation, which is by far the most common depreciation method used for financial reporting purposes. I'm going to close this video for you to review depreciation and to get a good handle on straight-line depreciation. And when you're ready, go on to the next video that will look at the other kinds of depreciation.